This was to evaluate recent economic developments and to assess risks to the outlook in terms of inflation and growth. And this briefing, just as the past ones, summarizes the key discussions and the committee's decision on the monetary policy rate. So first, in the global context, growth has held steady despite major policy shifts supported by easing financial conditions and fiscal stimulus in many countries. Notwithstanding the steady growth conditions, the outlook remains fragile amid a still volatile trade environment and ongoing geopolitical tensions. Global headline inflation has eased further on the back of lower energy and food prices. However, the pace of ease in inflation remains uneven, especially for countries adversely impacted by the volatile trade environment. The ease in global financing conditions since April 2025, driven in part by declining long-term bond yields and stronger equity markets, has helped moderate external financing risks. Central banks are monitoring these developments closely, and policy decisions in the months ahead will be driven by incoming data, especially on the trajectory of inflation. Now, on the domestic front, growth continues to gain momentum. Following the strong GDP outturn of 6.3% in the first half of the year, the monthly indicator of economic growth, recently released by the Ghana Statistical Service, points to a provisional growth of 5.1% in August 2025, compared with 4.9% in the same month of last year, and this was driven by the services and agriculture sectors. The composite index of economic activity is also posting strong gains. At the end of September, the bank's updated composite index of economic activity, which we also call the CIA, recorded a strong growth outturn of 9.6% compared to 2.9% growth for the corresponding period in 2024. Industrial production, international trade activities, credit to the private sector, and consumption contributed to the increase in the index over the period. The latest confidence surveys conducted in October 2025 reflected continued optimism on current and future economic conditions. Also, Ghana's Purchasing Managers Index improved on account of new orders in response to the increased pace of economic activity. And these taken together, the gains indicate that the negative output gap is closing so far. The expectation is that should this momentum be maintained in September 2025, the GDP growth outturn for the year will remain strong. Now on inflation. Inflation decline in the year has been steady and on target. From 23.5% in January 2025, headline inflation has eased to the bank's central target of 8.0% in October. The decline was broad-based as both food and non-food inflation are currently in single digits. And let me say that this is the first time since July 2021. The sustained disinflation has been driven by the continued maintenance of a tight monetary policy stance, sustained fiscal consolidation efforts, a stable currency, and relative improvement in food supply. Also, the bank's core inflation measure, which excludes energy and utility, has declined, reflecting significant moderation in underlying inflationary pressures. Price expectations by consumers, businesses, and the banking sector for the next year signal well-anchored inflation expectations. The bank's latest near-term forecast show that inflation will continue to decline and settle between 6.6 to 8% by the end of the year. On interest rates, these have generally declined in line with the reduction in the monetary policy rate. The interbank weighted average rate declined to 21.0% in October 2025 from 27.7% in the same month of 2024. The interest equivalent of the 91-day benchmark rate eased to 10.6% in October 2025 from 25.8% in October 2024. Also, average bank lending rate declined to 22.2% compared with 30.5% in the same comparative period. This has triggered a gradual recovery in private sector credit growth. From 7.1% contraction in May 2025, private sector credit growth in real terms has improved to 5.4% in October 2025. Now, on the fiscal side, budget performance over the first 9 months was marked by strong fiscal consolidation, as announced recently by the Finance Minister in his budget presentation. Revenue and grants fell below the target by 4.7%, while expenditure was below the target by 15%. This resulted in an overall fiscal deficit on commitment basis of 1.5% of GDP, which was better than the target deficit of 3.2% of GDP. The primary balance on commitment basis recorded a surplus of 1.6% of GDP compared with the target of 1.0%. As at end of October 2025, the total public debt stock was 45.0% of GDP compared with 61.8% of GDP at end December 2024. The decline in the public debt was attributed to effective debt management, reduced borrowing costs, and appreciation of the local currency. Deposit money banks remain sound, profitable, and well capitalized. The financial soundness indicators, including solvency, profitability, asset quality, and efficiency indicators, these all point to relative improvements in year-on-year terms. The non-performing loans ratio declined to 19.5% in October 2025 from 22.7% in October 2024. And this was driven by pickups in bank credits and contraction in the stock of NPLs. However, credit risks remain elevated, and looking ahead, policy actions to recapitalize the few undercapitalized banks and full implementation of the new regulatory guidelines that are aimed at reducing NPLs would further strengthen the banking industry. Now, on the external sector. The external sector conditions remain favorable. The current account improved significantly in the first 9 months of this year to a surplus of $3.8 billion compared to a mere $553.6 million in the same period last year. The trade surplus increased to $7.5 billion on the back of a surge in gold and cocoa export earnings. Private inward transfers remained high at $6 billion at the end of the third quarter. The current account surplus, together with favorable balances in the capital and financial accounts, translated into an overall balance of payment surplus of $1.8 billion and supported an accumulation of reserve assets to $11.4 billion in October 2025. And I must say that this is equivalent to 4.8 months of imports cover. Reserves are projected going forward to increase even further by the year end. The reserve accumulation efforts have helped indeed to provide cushion for the currency, with the CD strengthening against the major trading currencies. In the year to 21st November 2025, the CD recorded an appreciation of 32.2% against the US dollar. Now, in taking the policy decision, the view of the committee was that overall macroeconomic conditions have broadly improved. Given the anticipated significant decline in inflation by the end of the year, the tight monetary policy stance, the significant buildup of reserves, which is providing anchor for exchange rate stability, the bank projects a continued stable inflation profile around the target and well into the first half of next year, 2026. This is against the backdrop that current risks in the outlook to shift the path of inflation away from target have moderated significantly. Hence, the prevailing high real interest rates provides some scope to ease policy to further boost the growth recovery efforts. So, given these considerations, the committee, by majority decision, voted to lower the monetary policy rate further by 350 basis points to 18.0%. The committee will continue to monitor developments and take the appropriate policy decisions to ensure sound and stable macroeconomic conditions. But we have one additional measure. In addition to the policy rate reduction, the bank will now return to the use of the 14-day bill as its main instrument for conducting open market operations. The next Monetary Policy Committee meeting is scheduled for January 26 to January 28, 2026. And the meeting, as usual, will conclude on January 28 with the announcement of the policy decision. I thank you for your attention.